Hello and welcome. This is Financial Statement Ratios Part 2, the Activity Ratios. This information and opinions in this presentation are those of the author only, Bennett Tchaikovsky, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community Colleges District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at bennett1812@gmail.com to discuss. Note the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. So I want to start out this presentation by again giving a huge shout out to Investopedia. They are not paying me to make this video. Rather, I use them for a lot of the definitions in terms of the ratios, and they deserve credit for them because they've put together an amazing website. One of my former IVC students who was in my managerial accounting honors program a few years back and who went to UCLA was able to get an investment banking internship, and she attributed it to her spending a lot of time on Investopedia. So there must be something correct that's going on. So the next set of ratios, the first part of our videos looked at the liquidity ratios, and now we're going to be going through and doing the activity ratios. And the first one we're going to look at here is the inventory turnover ratio. Now remember, before we choose a ratio, we need to make sure that we've done common-sized financial statements. And please refer to my earlier video on that, because when I'm selecting a ratio, it needs to be relevant. If a company has no inventory, then can I and should I be doing the inventory turnover ratio? And the answer is no, because this is really to help us analyze a company that has inventory. So here, per Investopedia, activity ratios measure the amount of resources invested in a company's collection and inventory management. Because businesses typically operate using materials, inventory, and debt, activity ratios determine how well an organization manages these areas. So here, the inventory turnover ratio is how many times has a company sold and replaced inventory during a given period. Now, what's interesting is inventory turnover ratio can be computed during two different ways, which is cost of goods sold divided by the average inventory, our average inventory being our beginning inventory plus our ending inventory divided by 2, or it can be total sales to average inventory. I found both online, so if I found something online, it must be true. The higher number, generally the better, and the higher number can indicate insufficient inventory and strong sales, and the lower number can be weak sales or excess inventory. The inventory turnover ratio becomes extremely important for, say, a fashion company or a fashion-forward company where the inventory is constantly changing. So it's not a basic Amazon Basics black polo shirt that is going to be standard forever. If I'm a fashion-forward company and I'm coming out with new designs, one of the things I really have to be careful of is, like, how do I go through and, how do I go over and sell my inventory quickly? And inventory, I want it to sell quickly, because if I'm carrying too much inventory, as we have kind of seen some from the liquidity ratios, is that can be problematic just in terms of draining on my liquidity. So let's go ahead and look at some examples, and we'll revisit the same 3 companies that we did before, which are Home Depot, Lowe's, and Facebook. Okay, So our inventory turnover, the one I'm going to be using, is the cost of goods sold divided by the average inventory. For the Home Depot, as of January 28, 2018, and notice here, I'm not using the quarterly reports that I did before because I need to get a full year in. Now, these ratios that I'm computing right now are going to be stale dated. Why? Because Home Depot over the last 3 quarters has already been reporting its cost of goods sold. So I'm really doing this from more of a historical perspective because I don't want to sit down and do trailing 12 months. I could, but I don't want to. So right here, what I'm going to be going through and doing is to say, okay, what are my cost of goods sold? My cost of goods sold for the Home Depot was $66.5 billion. So we got $66.5 billion. And then I have to say, what is my average inventory for Home Depot? Well, it's my beginning inventory, which is the ending merchandise inventory from last year, or $12,549 million, plus the current merchandise inventory of $12,748 million. And so here what I get is I'm dividing those through, and my average inventory for the Home Depot is $12,649 million. So here my inventory is turning over 5.26 times per year, or an average of 69.37 days. How did I get 69.37? I took 365 and I divided it by 5.26. Is that good? Is that bad? Well, we want this number to be higher, the better. But for a company like Home Depot that's really selling a lot of, construction staples, this might be an okay ratio. Let's now take a look at Lowe's. When we go to Lowe's, Lowe's has cost of goods sold of $45.2 billion for the 12 months ended, or the fiscal year ended February 2nd, 2018. And then their average inventory was right over here, was their beginning inventory was $10,458 million. Their ending inventory was $11,393 million. So right here, Lowe's has an average inventory of $10.9 billion. So their turnover is 4.13. In terms of days, it's taking Home Depot longer to turn over its inventory into sales. So again, Home Depot is taking 88 days. Is that a good or bad thing? We don't know. It's about 19 days longer than Home Depot is. Home Depot is a little bit quicker. The other thing that you have to remember too is that when I look at Home Depot, from a revenue standpoint, Home Depot had about $100 billion of revenue for their fiscal 2017, whereas Lowe's had something around, let's see right here, their sales were about $68.6 billion. So about 30% less than that of Home Depot. So again, are they carrying too much inventory? I have no idea, but it's something that we would want to be looking at if we're going through and analyzing this company, mainly because, well, it seems that Home Depot is performing better than Lowe's. So the next one we're going to go to right here is for Facebook. And for Facebook, if I was to try to do an inventory turnover ratio, and if you were one of my students and you decided to analyze this on a test, you would get a big donut, a bagel, a 0. The reason is no inventory, okay? And my personal information does not count as Facebook's inventory. I'm sure it's there, but it's not part of their inventory. So it's something that's very important to remember. Now, if I was a member or a user of Instagram prior to Facebook acquiring it, was there a value to my information? And that answer is yes. Take a look at intangible assets when Facebook, in fact, went out and acquired Instagram. They put a value on those users. It's pretty fascinating. So This one here, so for the inventory turnover for Facebook, we're just going to put here, not applicable. And let's go now back and look at our next ratio. Our next activity ratio is the asset turnover ratio. What exactly is the asset turnover ratio? It measures the value of a company's sales or revenues relative to the value of its assets. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using its assets to generate revenue. Thank you, Investopedia. I could not have said it better myself. So here, the asset turnover ratio is going to be my total sales or my total revenue divided by my average total assets. So it's going to be my beginning total assets plus my ending total assets divided by 2. Generally, the higher the ratio, the better the company is performing. So now let's take a look at the total asset turnover ratio for the Home Depot, Lowe's, and Facebook. The Home Depot had revenues for their fiscal 2017. And why is it fiscal 2017? As a retailer, you generally want to close your books the month after the year end, and that's what they do. They have a January 28th or early February year end. It's just how they do it. So it's easier as a retailer, it's easier because especially when the holidays come through, is to really choose a year end that's essentially after December 31st. So right here for the Home Depot here had sales of $100 billion. And their average total assets is going to be, they had total assets here of $44.5 billion. Total assets in January of 2017 of $42.9 billion. So here the total asset turnover ratio for the Home Depot, or how well are they managing their assets, is pretty high. It's about 2.3. So again, they're being pretty productive, you could say, with their assets. For Lowe's here had sales of $68.6 billion, and let's make sure, yep, I got it right, $68.6 billion. Lowe's average total assets were right over here, 35.291 and then 34.408. If you're wondering how I found these companies, please see my prior videos on how to look up SEC company or publicly traded companies. So right here, Lowe's is below Home Depot, and it's got here about $68.6 billion in total sales and about $34.8 billion in total assets. So right here are the calculations of how I came up with that. Facebook, believe it or not, for the first time in this presentation, their total asset turnover is actually lower than both these companies. And let's just take a look real quick because maybe I got this wrong. So Facebook had revenue of $40.6 billion for the year ended December 31st, 2017. Wow, look at this increase. They were at 17.9, 27.6, and now they're at 40.6 billion. And so right over here for Facebook, their revenues were 40.6 billion. Now, when we look at the assets, the total assets of Facebook, they're at about 84.5 billion. So their average total assets are 64.9 billion and 84.5 billion. So their average total assets are roughly 74.743 billion. So their asset turnover is at about 0.54, which is lower than the Home Depot and lower than Lowe's. But again, we can't really use this as a great comparison just because they are in completely different industries. What's interesting, if you look here about the assets here of Facebook, is they have a huge dollar amount here for goodwill. And when you look at goodwill, it really represents the excess price paid above the fair market value for the assets. So Facebook has made a number of acquisitions, and they've had to put goodwill, which is an asset, but it's an intangible asset on their books that it is productive, but it's one of those things that it really kind of ups the total amount of the assets. It's not like cash or the like. And so it's going to take them a little bit longer in terms of time as far as getting that total asset turnover ratio up. But clearly, based on their revenue, I haven't looked at their quarterly reports recently in terms of revenue, but as far as their revenue goes, it's been growing at a pretty significant clip. So the last ratio we're going to look at is, as far as the activity ratios are concerned, is the accounts receivable turnover ratios. And when I have here the accounts receivable turnover ratio, the way that Investopedia is defining this is that it determines an entity's ability to collect money from its customers. So here I have my net credit sales divided by my average accounts receivable gives me my accounts receivable turnover. Now, for the companies we're analyzing, and here's what net credit sales are: it's sales on credit minus sales returns minus sales allowances. If the number is high, management is doing well with collecting. If it's low, there may be a deficiency in the collection process. So if we take a look here at the ratios, let's take a look at the companies. So if I look at the accounts receivable turnover, is this something I should be doing with the Home Depot? And my answer would probably be no, because receivables are so small for the Home Depot. It's about $1.9 billion. They have $44.5 billion of total assets. It's less than 5%. And when I go to Lowe's, there's no receivables here. They could be a part of other current assets, but I don't know because it's not broken out separately. It's not significant enough to have it be broken out onto the financial statements in its own category. So when I look at this, I'm kind of going, well, accounts receivable turnover is probably not a good one to run for either of these companies. And it's just because these companies don't have a significant amount of receivables. Remember, when I'm giving a ratio, I want to make sure it's important for analyzing the company. If they have no revenue, if they have no inventory, that just means that we shouldn't be looking at that particular ratio. Now, when I go to Facebook and I look at their total asset, like I look at their accounts receivable, about 5.8 billion, you know, this is going to be more than 5% or less than 10% of their total assets. But here, if we look at the definition of the, if we're going through the definition, is my net credit sales. And what exactly is that? It's my sales on credit minus my sales returns minus my sales allowances. My challenge would be is I don't know for Facebook of this 40.6 billion, well, how much of that was in cash and how much of it was on credit? That does not mean credit card. It means that Facebook has actually gone out and extended credit to a particular company or vendor. So it's kind of a hard thing to actually run this ratio for Facebook because I don't know what their net credit revenue, what their net credit sales are. I could possibly find that out by doing a lot of research, but we don't have that time here today. So instead of doing that, I'm going to show you an example. And this is my favorite law firm called Dewey, Suom and Howe. Dewey, Suom and Howe. I love that name. So right here, or Chase Ambulance, you know, take your pick. Dewey, Suom and Howe had total sales of $10 million, of which $9 million were on credit for the year ended December 31st, 2017. Remember, we're going to do an accounts receivable turnover ratio here for Dewey, Suom and Howe. So I've got net credit sales divided by my average accounts receivable. It then tells us that the sales returns and allowances from the credit sales were approximately $50,000. So my net credit sales are going to be my sales on credit minus the sales returns and allowances, or right over here of $8,950 million. I'm going to divide this by my average accounts receivable. Well, my accounts receivable, my beginning accounts receivable is going to be the end from the prior year. This 12/31/16 becomes 1/1/17. So my average accounts receivable are going to be this 3 million plus this 3.5 million divided by 2, or 3.25 million. So to compute my accounts receivable turnover ratio, I'm going to have here my net credit sales of 8.95 million My average accounts receivable is 3.25 million. So my accounts receivable turnover ratio is 2.75 times. Now, in terms of showing this, in terms of the number of days, if I take 365 divided by 2.753846,154, I'm going to get 132 days. Is that a problem? It's a huge problem. And unless you're dealing with a governmental agency, if it's taking you 132 days to collect receivables, that's a huge problem. And or if it's something that's part of your industry, it may be okay. But again, for a company here like Dewey, Suum, and Howe, they need to figure out ways of getting paid more quickly. The challenge for Dewey, Suum, and Howe is that if they don't get paid quickly, they're going to have to find financing if they need it from other sources. And there's a cost to that financing. So, and I've done some videos on receivables before. Go back and take a look at those. And there, I have some techniques in there in terms of trying to be more aggressive in terms of the collections of the receivables. So those are the activity ratios, really accounts receivable turnover, total asset turnover, and inventory turnover. And I want to give a big thank you and thank you for attending or for watching this presentation. Please do not forget to like, share, and subscribe. And if you have any feedback on this presentation, you can use the earlier email, or you can send me an email to 1812cpa@gmail.com. I welcome back any type of feedback you have. If I make an error on a presentation or if I can clarify it better, I want to thank you for helping me with that. Have a great day, and we'll see you on the next video. Take care.